Okay, so now we're going to talk about something that everyone's talking about right now, which is interest rates. Some people think that the world is going to crash and burn. Some people think this is a great thing. But here's someone that's actually in the financing world day in, day out. They're dealing with interest rates all the time. So Darren, tell us, what's the deal with these interest rates?
Yes, yeah, definitely. There's definitely a big misconception out there about interest rates and the way that they're headed. You may have recently heard that the Feds raised the Fed funds rate by 0.75%.
Yeah.
So a lot of people are out there thinking, oh no, mortgage interest rates are going to go up. When in all actuality, that Fed funds rate is meant to slow down the inflation rate, which actually helps with mortgage interest rates.
Yeah.
And the best way that I can explain that is because inflation going up means rates are going to go up on mortgages. So the best way that I can explain to you is, let's say I were to give you a 30-year mortgage and you're making, let's say, $1,000 a month payment to me. Over time, that $1,000 that you're giving me is going to lose buying power over the 30 years because inflation's going up. That's primarily why interest rates go up when inflation goes up. So the Fed's raising the Fed's funds rate is actually meant to help slow down inflation, and eventually we're going to see mortgage interest rates drop with that. Yeah. So that's the best way to explain it. And unlike 06, 07, 08, during that time, the housing market is what caused the recession, where this time around it's the complete opposite.
Yeah.
So it's a very complete opposite. We have a lack of inventory and a bunch of demand, which is causing the housing market to increase. Whereas last time we had too much inventory and we couldn't fill in all the houses. Yeah. So inflation is the primary killer of mortgage interest rates, not the Fed's funds rate. The Fed funds rate, eventually that's going to actually help with mortgage interest rates.
Yeah, it's like cleaning your room. You have to get a lot messier before it can get cleaner, right?
Yes.
It's going to hurt a little bit before it starts to get a little bit better, because that's just how you curb it a little bit. That's at least what they're trying to do from this.
Yeah, no, absolutely. And so I mean, what you'll notice is that generally speaking, a recession will come after we hit the lowest unemployment number, meaning everybody's employed, everybody's out spending money because they're employed. And then what happens is these businesses, they hire on more help to keep up with the demand. And then with inflation going up, they start to not go out as much, not travel as much. And then these people that hired all of these additional helpers will start to have to lay those people off. And that's why as soon as the unemployment numbers hit the lowest, not the highest, the lowest is when typically you're going to see the recession. And all a recession really means is 2 quarters in a row at negative GDP growth.
Yeah.
So
it's not always as
it's
scary.
not necessarily like the market's coming down and crashing.
Well, and then last time too, it was all superficial. It was all, the bubble was made by superficial purposes because they were handing out loans like it was candy. And like you said in another video, like you fog up a mirror, you're going to get a loan on a property. And then what happened was these people couldn't pay it. And so now you flooded the market with inventory because people couldn't afford it, which meant that they just had to give their property away essentially.
Right.
And in this case, that's the only way to get that market crash, is you have a ton of people all at once that either can't afford it or they're willing to sell for less. And right now you're seeing people that, like, everybody that you talk to is like still wanting $50,000 more than their house is worth.
Right.
It's a very strong market. It's just low inventory and a super high demand.
Right. And one of my thoughts on this, and I heard this the other day and it's kind of interesting, is that the millennials, they're now entering 31, 32, 33. A lot of the millennials didn't necessarily get out of high school and get married and get a job right away. A lot of them stayed at their parents' house and they've been saving their money. And so what's happening now is they're hitting that home buying age, and they're cash heavy, and they're have higher salaries now, good paying jobs.
Yeah.
And so what they're doing is they're buying up all this inventory, and they're not relinquishing or selling another property because they were living with their parents. So they're not creating more inventory as they leave.
Yeah.
So that was kind of interesting when I had saw that, and it's I think true.
Yeah, I mean, that's even from just personal experience and seeing people like that. That's, I mean, the few generations before, they would move out 18 years old, buy a property, and you know, that was as soon as they could, and then they would move. But then, yeah, these guys, they have, it's like two different buying fields now. You still have the people that want to jump into a house right as soon as they can afford one. Right. But you also have this whole other wave of buyers that have been saving up. And as the market just got like white hot over the last couple of years, the cash heavy seemed to win because they could outcompete the other ones.
Sure.
But that doesn't mean that other whole buying sphere like went away. Absolutely. They were just getting outperformed. Right. So it's like now, you know, some of these cash heavy people are a little bit more satiated because they got some of their properties, and now it's like we're still in a super hot market.
Right.
But
yeah, I mean, with any rising rate environment, you're going to see buyers step off to the sideline. Yeah. You know, as of course, with the higher interest rate, the payment's going to go up. Higher appreciation on the properties, the payment's going to go up. So a lot of these first-time home buyers, they're either stepping off to the sideline and they're going to wait until it's more affordable for them. But now is the best time more than ever if you're a buyer, to get out there and secure a property without having to necessarily go 20, 30 grand over list price. Because keep in mind, you'll have the property for when financing terms become more favorable, and you can always refinance your mortgage and lower your payment.
Yeah, and that's what I always ask people too, is they say that they're waiting for the market to dip or to do whatever, and or they're just saying that they don't want to do it right now, and I'm like, well, do you think that it's going to change in the next 5 years? Do you think that the properties that you're looking at are going to be worth less in 5 years than they are right now? And almost universally, the answer is like no, because we've been watching California prices for decades, and they continue to go up. So it's like, okay, we used to have interest rates at like 18%, like, and 12%, 16%. Like, this is new that we're so low, going back up to 5 and 6%, and we still had appreciation at 18%. Interest.
And I mean, aside from that, the rents being so high, the rent can change any time on you. When you have a mortgage, that payment is generally most people go with a fixed rate mortgage. So it's going to be a fixed payment for the term of their loan, which is always nice. You know, if you're a renter, you never know if your landlord's going to want to sell, or after your lease is up, it's going to bump up the rent.
Right.
So it's just one of the single best investments you can do is real estate. It's the biggest hedge against inflation.
Yeah, and then all of us look at those people that have $1 million or $2 million houses, and we're like, what? They're only paying like $3,000 a month, and it's like, well, yeah, because they bought like 10 years ago, and it's like now they're sitting pretty with a low down payment because the property skyrocketed. Their payment stayed the same. It's like you can look at that the same way with you. It's like if you buy now, it might be a little bit like expensive now. But at the same time, in 10, 20, and then 30 years later, it's like, okay, well, do you think that your $3,000 a month payment is really going to be the same in 30 years? It's like, that's going to be like $1,000 payment now. Like, it was so affordable. And, you know, a couple of years into it, especially with inflation, we know that inflation almost always ends up in real estate. So they just pump trillions of dollars in the economy. Real estate prices are going to continue to go up rapidly, probably. And, you know, so it's like, make your move now.
Yeah. I mean, we can't build fast enough to keep up with the demand. So, and rent's 100% interest. I mean, $0 of your rent is going to pay down a principal balance of a home. And whereas, you know, if you have a higher payment on a mortgage, it might be, you know, $200 or $300 more than what you're paying in rent, but at least you're paying that balance down slowly but surely, as well as gaining appreciation on the property. So just because it's a 30-year mortgage doesn't necessarily mean you need to stay in that property for 30 years. Actually, last I read, the national average for somebody to stay in a home is only 5 to 7 years. Either they relocate, or their family grows, or they want to upgrade or downgrade. So a lot of that plays into factor as well.
And then in 5 to 7 years, you're not starting from scratch. Now you've actually built some equity in there, and you've taken advantage of appreciation, which, so like in a healthy market, solid appreciation. 6% appreciation in a year is good.
Right.
But then in the last 2 to 3 years, we've been seeing almost 20% a year. So it's like you could have bought your starter home 2 years ago, and now already it's like boom, you've got all that appreciation. But you're not starting from scratch every time. You're starting to keep building that equity, and then you can use that to kind of parlay it over into your next property if you want to.
Exactly. Which may lead us into speaking about contingent purchases.
Yeah.
I know you had brought that up before in conversation, and a lot of people don't realize when they own a property that they're able to buy another property and not have to, and they can sell their property that they're living in without having to move out of their property to move into another property.
Yeah.
If you were to come to me as a mortgage lender, I can actually pre-qualify you contingent on you selling your property. So you stay in your property, you go, with your pre-qualification, submitting offers contingent on you selling your property. And then when you get into escrow on your new property, you can go ahead and list the property that you live in, and we would close most times concurrently. So it makes it for a smooth transition.
Yeah, that's a super helpful option, especially so right now. We have a lot of people that want to sell their house. They want to take advantage of the appreciation. They want to take advantage of the equity. And they're just like, well, where am I going to go? Because if I sell at the top of the market, I don't want to buy in this market because it's too hard. Well, timing the market is almost impossible. Everyone wants to sell at the top and buy at the bottom. But the odds of that actually happening is can you pinpoint a time in 2006, 7, 8? It's like, you're still got a time to wait, right? Like in between. So it's like, I always tell people it's the right time to buy or sell is when you need to buy or sell. Because if you're going to sell at the top of the market, you're going to buy at the top. If you're going to buy at the bottom, you have to sell at the bottom. Like pretty much all the time, you're buying and selling in the same market. So the contingent sale, you can pre-qualify people based on what they're gonna before they actually sell their property, right?
Right. Meaning, you're qualified for the new loan as long as you sell your property. And we don't have to wait for you to go ahead and do that to get you a pre-qualification and start your home buying experience for the new property. And even if you have, let's say you have $100,000 in equity and you only want to put $30,000 down on the new property because you have some debts that you want to take care of, and you want to use that equity from your house that you're vacating, you can certainly do that and still do a concurrent closing with the other property, and escrow can just the escrow company can just allocate the proceeds from the sale of your property to pay off some of those debts and some of it for the down payment, and you maybe even put a little bit money in your savings account.
Yeah.
And you start out fresh on a new foundation financially with your new property.
Yeah, absolutely. And then selling and buying at the same time, it was a little bit tricky. Maybe it's just a little bit less common when the market did get so hot. Because there was, how are you going to compete with contingent sales and all this kind of stuff? I need to wait for my house to sell. Meanwhile, you're competing against a cash offer that's like $50,000 over. It's a little bit, but as we're starting to see a little bit of a calming, not all the way, but we're starting to see a little bit of that. It's getting more and more of a legitimate option. You can, as a seller, you can either put a contingency that we call a lease back. So you can sell your house to somebody, and then you can ask them as part of the terms of the sale, hey, I want to live in my house for 3 months after the actual close, and I'll pay that rent. Or you can negotiate, right? You just say, I want to stay in my property for 3 months after it closes, or however long, so that I can have the money already in my bank ready to go buy something, and I can have that money available instead of having to make it contingent. And then, or like we said, you can do a contingent sale. So you make an offer on a property, and then you just, say that this is contingent on this other house selling. Obviously, there's ways to position yourself to make that a stronger offer. You don't really want to make an offer and your house isn't even on the market. And you say, well, I do like this house, and maybe I'll sell my house to get it. It's like, you guys are still a month or two off. They're going to take the cash offer that's ready and waiting. Yeah. But if you're in escrow already, or you've at least listed your house, but if you're already in escrow, and then you go and say, hey, it's an escrow, here's the qualifications for my buyer, everything's going smooth, we're good to go. That's a lot more appealing to another seller to say, okay, chances of this thing actually going through is good. So there are definitely ways to make that work to trade up.
And to kind of piggyback off the lease back, you know, you can sell your property and have a lease back like Caleb was mentioning. And then from a bargaining standpoint, obviously cash is king. So when you're bargaining for your new property, you purchase it cash. And you could come back to me within 90 days and do something called delayed financing. Where as long as it's your primary residence that you're purchasing and you're within that 90-day period of purchasing your home, you can come to me and we could recoup up to 80% of that purchase price that you bought the house for.
Yeah.
So and then essentially it's like you did 20% down payment on a new home, but you got the benefits of purchasing the home cash.
Yeah, so it's like a more convenient refinancing, right? You don't have to wait for a full-on refinancing. You know, it's a little bit of a smoother process.
Yeah, and you get all that capital back that you spent on the purchase of the home.
Yeah, absolutely.
Yeah. So and that's why it's important to have a good trusted loan officer and real estate agent on your side. So that we can negotiate these things for you.
Yeah, and having agents and lenders that know these options is a huge help, because you know I'm shocked, but I've seen so many people that are like, I talk to them and they're like, I didn't know I had any options. I didn't know any of that even existed.
Right.
And it's like, man, you could be saving so much money. You could be getting into not even just saving money, but you could get the house that you wanted.
Yes.
You don't just have, you don't have to just fit into one box.
Right.
There's so many different things that we can do to help. So
absolutely.